where we will be covering the topic of the possibly one of the more popular adages of trading, which is that 95% of retail traders or thereabouts lose their shirts. And today I'd like to basically take you through some public data that will partially prove but also disprove this notion. More importantly, because whatever others do doesn't really matter to your personal accomplishments, we will try to explain why losers lose, because hopefully there'll be some lessons that you can apply to improve your personal trading. And at the end of the webinar, I'd be very grateful for any suggestions to do with anything Darwinix, starting with possible webinar topics, functionality upgrades, things that you like or dislike or don't understand about Darwinix, and so on and so forth. But more on that later. Throughout the webinar, feel free to write stuff into the question box. I will do my very best to answer whatever questions I can there and then. And if I can't, or they're actually interrupting the flow for stuff that's coming later, I'll just ignore, but rest assured that we can always come back to stuff if you're uncomfortable towards the end of the webinar. Okay, so without further ado, let's just jump right into it. What I'm showing you here is data that I believe the NFA forces American broker-dealers, FCM registered broker-dealers, to publish on profitability by their users. I have used some entries by finance magnates, or for the former forex magnates, who compile these data from different brokers every quarter. Now, more importantly, what does the data say? Well, it says that within a quarter, out of the accounts that started the quarter and finished the quarter, for interactive brokers, 45% were in profit and 55% were in loss. Now, similarly, if you go down the list of brokers, you'll see that there are quite significant variations across different brokers. And this brings me to a couple of points. So the first one is this neither proves nor disproves this 95% of losers thing, because what does 95% of losers actually mean? What this is saying is that in a quarter, 45% win and 55% lose with interactive brokers, but you don't really know what happens after possibly 5 or 6 quarters, and how far the drain gets, you don't really know from the statistics, but it's a start. It also is interesting in the sense that it shows that different brokers or different pitches attract different behaviors or attitudes, with the likes of IBFX, for whatever reason, attracting guys who tend to lose at least faster, if not more, than with interactive brokers. So it looks as though there's some losing going on. Whether it is 95% or not, it's hard to tell, and it certainly depends on the broker, as you can see from here, because like a difference in a user base of 23,000 accounts from 30% to 45% is quite significant, if you can see the difference between FXCM and interactive brokers. So if anyone of you is interested, I will actually share the deck. So this thing will take us to the link with interactive brokers that shows the evolution of these numbers, which tend to be reasonably stable over time. I've been watching this for like a couple of years now, and that's what they roughly are. So if anyone's interested, I'll share the deck and also some of the spreadsheets I'll be mentioning, so that you can look at this and more numbers in your own time. Now, how about this side of the pond? As you know, we're FCA regulated and located in London. So I'm afraid the FCA, to the best of my knowledge, does not force. Well, it certainly doesn't, because if they did, I would know about it. So they don't force people to show their profitability. But what we do have is, for listed brokers, we have what the management publishes in their annual accounts or information for investors. And that is interesting. So in here, we see for a brokerage, the numbers of active customers in the bottom row. So number of active customers, roughly stable at 50,000. This is, I think, plus 500 numbers. What is interesting is that despite their sourcing 20,000 customers per quarter, which adds up to a total of 80,000 per year. Basically, what it's telling you is that to keep 50,000 customers active, you need to source 80,000 customers per year to just stay on the same place. So it does look as though people either lose everything they've got or they have a pretty strong tendency to quit within the year, as you can see here. So it's quite a bit of churn for this particular brokerage. Hans is asking if I have the numbers from Darwinix. I have numbers from Darwinix, but I was hoping to show more numbers than I will be showing today. But the fact is, we have started from a very small customer base, but we're also growing at about 15 to 20% per month in active customers. So that both the small size and the growth, I believe, make things look deceivingly bad, in the sense that our guys have been going, and I'll show you some numbers for Darwinix later, but some of the guys that are with us are still with us, and we only know when they started with us. So if I showed you numbers that people have been with us for like 2 months, it would be misleading in the sense that I know for sure they'll be staying with us for much longer. But I have some numbers for Darwinix, and we'll show them later as well. I have to say, if I look at the numbers for our community, it looks like we are a magnet for the more persistent type of guys. So we have lifetime values of people who stay for very long with us, and we don't tend to attract the kind of churn type of guys, if anything, because we don't do any advertising, and most people come through word of mouth, presumably because they're traders who already know other traders. Sorry for the X-course. So as you can see here, so to keep 50,000 retail traders active, they need to source 80,000 traders per year. So looks like a pretty big churn here. And then the one phase which doesn't really fail is a look at the books of a market-making broker dealer. These numbers are from IG Markets, in my humble opinion, one of the best run retail shops out there. And what they show is in this chart is very, very interesting. So what you see here is a histogram showing the count of trading days in the first half of 2016 versus trading P&L made in the day. So this, for instance, this point here with the 12 says there were 12 days in the first half of 2016 where IG Markets made 1.4 million of trading revenues, give or take. So I was flabbergasted when I saw this, I have to admit. So do you guys see anything which really is pretty amazing, in my opinion, in this chart? So any bets? Who sees anything strange in here? Remember, we're trying to gauge how many winners and losers there are. I guess that the more winners there were, the thinner the winning days ought to be for the dealing desk of a dealing desk broker. And I guess you guys are all shy here. What we've got here is a pretty impressive number that is telling us that IG Markets didn't lose a single day in the first half of 2016. So if you have the cushion of the spread that you're charging customers, it looks as though there are very, very thin chances indeed that you're going to lose on average against your average customer book. So this is roughly a pretty indirect way to say it, but what they're saying is on average customers tend to lose. And yeah, I mean, if there was any nice way of putting this in words, you could say we're making money off our customers' losses, or you could say we're maximizing the value of natural client offset, which sounds a bit more neutral. Let me put it that way. So there you go. I think the overall numbers are already telling us the story. So the story is, on average, retail customers tend to lose, but retail customers do not always come in equal sizes, because as you saw, the numbers for interactive brokers were far better than they are anywhere else, which is hinting at one of the messages today, and that is that it is all down to individual behavior. So why did I pick this Darwin? Well, this one has a long story of us being criticized for sort of promoting reckless behavior. So what we've got here is the evolution, the percentage evolution of one Darwinex account, which, as you can see, is not atypical for what happens elsewhere. And that is, I trade with a whole boat of risk. Sometimes it goes well, so this actually multiplied the value of the initial deposit by 5 times, or 5 times in a short period of time. But then also in an equally short period of time, the account was in percentage terms kind of wiped out. So does this prove the point that retail traders are some sort of subhumans who kind of are doomed to lose? Well, it does, and then it doesn't. So what if I showed you that this curve, which is up 37% as compared to down minus 99%, is actually one and the same strategy? Would you guys believe it? So no comments here. It's funny how when I do the Spanish session, there's a lot of guys who jump to comment, and you guys are more laid back, which is nice insight into cultural differences. Anyway, so we've got here. This is one of the Darwins that I've picked, not because it's particularly good or bad, just because it highlights the point of how different an account can look depending on the degrees of leverage that you apply. So if you look at somebody who trades with a value at risk, which is close to 100%, which is about as high as it gets, this is what happens. If you had traded the very same strategy, with a target of value of risk of about 20%, which is about as risky as a high risk stock, then in this case, well, we have a very, very significant drawdown here, as you can see. But nevertheless, over the space of oddly 13 months, the account is up 36%, which is, obviously, if you started here, and you left here, you'd be in pretty bad shape. So, but overall, if you hang on to your guns, well, maybe it wasn't so bad. And the only difference here, remember, is the leverage. And that, if we come back to the topic of the presentation today, is the subject or the single explanation of what's going on. So if you take the average customer base of an average broker, the fact is, on average, they tend to over leverage and churn. If you take that same customer base with those same strategies and you take away the leverage, then you end up with a bunch of guys who are neither better nor, importantly, worse than random. And that's about the idea. So if you take away the difference in risk, then retail traders are on average about as good as the hedge fund industry, which is they neither win nor lose. And as a bonus, retail traders do not charge you 2% for no performance. And that's, if I had to sum it up, that's the summary of where things come from. So with that being said, let's just look at what is causing this churn, which is not the quality of the strategies, which are neither good nor bad, but it's actually 3 or 4 very simple explanations. One is lack of experience. You probably know this thing. I have yet to face a trader who comes into this and doesn't lose his shirts on his first attempt, because it's just tough. Everybody overestimates his own good against the market, and sooner or later you hit the ground, and then some people come back and they eventually rise, but the first one is basically a pretty bad hit. Lack of experience, as we'll see. Then there's leverage and risk, which well, I'll show you with some with a visit to the bonfire of vanities in the Darwinex leaderboard. Then we'll have a look at transaction costs, and this one is one that really beats me. It defines me how people can go around and pay 2-3 pips for the euro dollar, given how much drain that represents in your performance. And last but not least, I'll recommend 2 books that will hopefully make for enjoyable reading and give you an idea or two for down the road. So let's get with lack of experience. So what we've got here is the a look into the experience as measured by date of first trade versus last trade, but this includes both active and inactive accounts. So coming back to Hans's points on the numbers for Darwin X, this is being unfair on Darwin X in the sense that a whole bunch of guys joined a couple of 3 months ago, and they're still going, and they would show up as a kind of dead body in here, which they really aren't. So I was hoping to show more about Darwin X, but only realized that the fact that we're so young and so growing was only going to reflect badly on our trader population. But the fact is, you have a bunch of guys that are really quitting, and there are some in here that are really quitting pretty early day in the process. I believe, just like with any other broker. The second one, and this one I think we can be representative, is just the huge amount of trades that many people take. So we're talking about monthly trades in here, and this is percentage of accounts. And as you can see, there's a pretty bump in here of what I would consider reasonably reasonable for kind of day traders, which is about 30 to 40 trades a month. But then you have a huge tail of people that do well in excess of 200. And yes, you could argue these are algorithms who are doing like optimization trades and so on and so forth, but there's a fair amount of guys who are even manual traders who are taking a boatload of trades per month. And the fact is, if you really think about it, if you had to pick one trade, you probably do put a lot more thinking and maximize the odds of success in your first trade, much more so than in your 1000th trade, which goes to proving that more is certainly not better, or possibly not better when it comes to trade profitability, and it certainly is far worse in terms of transaction costs. So this one is possibly the simplest Excel sheet I have ever put in my life, but it's one of the more revealing ones. What we're looking at here is on the horizontal axis, we're looking at monthly rotation. So how is rotation defined? It's the number of times that you rotate your balance in a month. So if you take 20 trades in a month with an average leverage of 10 to 1, then you'd be rotating your account by 200 to 1, so 20 times 10. So you'd be here. If you do that, say, 25 trades at 20 to 1, then you'd be in the 500 mark. And then depending on the broker you've picked and the commission plan you are on, then you'll be paying a substantial amount of commissions anyway. And if instead of going for a broker that charges, say, $5 per lot round trip like we do, you go for one that charges 0.6, you can see there's going to be a substantial drain on your account in terms of annual profitability. So what we've got here is the percentage of equity per year that you'll be paying in commissions depending on the different price plans you are. And no matter how you look at it, it basically says two things. One is it's awfully expensive to trade very often, because even if the commissions are low, the rotation adds up on every trade. And also, it's just plain silly to pay two pips on the euro dollar on average, because that basically means you'll never ever make any money long term. So I guess a lot of folks with brokers who charge that will never hear about this, because if they did, they wouldn't be with those brokers to begin with. But that's the insight they're missing out on. And last but not least, there's of course the combination of rotation and leverage, which I call the bonfire of the vanity. So I know we all know this, and you probably know it too, but then there's times when we all get carried away and we do stuff which is not good for us. So I just hoped to show you today a look at the Darwin X strategy leaderboard with a very, very simple filter. And that is, if you're trading with a leverage of, say, more than 30, 40 to 1, and you're taking more than kind of 20 trades per month, chances are you're trading with a monthly value at risk close to 100, which means you can wipe your account the worst month every 20. And so we've now come to the strategies that meet those criteria in the Darwin X leaderboard. And if we go to page 2, which I think is from the 15th downward, we started to see a very worrying trend. And you see the end result of all such strategies is what it is. So you're seeing the curve here. It tends to end badly. It could go very well for a while, but anyway, I think you get the picture, right? We don't need to go any further. And remember, we're talking about a brokerage that does not do any advertising that does not actively encourage gambling. So we're probably looking at a very biased sample in the sense that a lot of people do worse elsewhere than here. So if there's anything you don't want to forget, it's remember that everybody came into this thinking they're going to get rich overnight, and most end where they do end. On that note, I'm going to make another claim here, and it is as follows. Quite often we get complaints from people who, and I actually share their views in many cases, who say, well, somebody who trades with a value at risk of 100% should not be trusted and therefore should not even be listed at the Darwin Exchange. And there's a part of me who understands those comments. So I mean, don't think that I'm a crazy guy, and I certainly look twice before I invest my own monies in guys who trade with very high VARs. But having said that, I'll make a couple of points today that I hope will make you also challenge that view. And there are many cases. For instance, I'm going to give you an example of something that goes on a lot. So we're talking about a customer who presumably has, say, $100,000, no problem to invest, but who just doesn't trust brokers all that much. So chooses to keep a minimum balance with the broker to minimize the odds of that broker going down with customer monies in it. So what do? Well, you put down a deposit of 5K. You trade as if, with those 5K, including the risk for your 100K real investment. And as long as things go well, you keep the money there until you build up, say, 20K of profit, and then you withdraw. Or if you've blown the 5K or the 10K and it goes down to an overall P&L of -10 for the 100 you invested, then what looks like a capital wipeout with RNX is nothing than a margin call that you then replenish and you continue with the strategy. And we have a whole lot of customers and some of the best strategies with RNX that are doing just that. So they're trading a significant amount of capital, we just don't know how much. And whenever they blow the account, they just replenish. And whenever they're making profits, they withdraw. As a result of that, you would expect, if they were losers, for them not to withdraw more than they've put in. But the fact is, we have a whole lot of guys who have made P&Ls in the hundreds of thousands of positive dollars who would look like complete wipeouts on the value at risk analysis that we're doing here. Unfortunately, if we had a way to account for that, we would obviously calculate value at risk differently. But because we only can calculate it to have everybody competing apples to apples on the money that's with us, then what happens is you have people who are sort of artificially inflating their risk, who are fully rational and know exactly what they're doing, or at least they're making a killing in terms of money over the months, but who would look like a Darwin that, according to this more Puritan view of looking at it, should be banned from listing at the Darwin Exchange. And that is one of the reasons, in addition to our wanting to stay neutral, that we have really taken the thought not to eliminate Darwin's on account of VAR, because many of the best strategies we've got fall into that category. Obviously, they are a very small amount in the total number of strategies. So like what goes on is pure gambling in most cases, but there's just no way to tell a gambler from somebody who's doing that just on the basis of the value at risk. And that's one of the reasons why we are having a hard time in controlling what looks like reckless gambling on Darwinia. So sorry for the side note, but I just thought it would be a good opportunity to bring this point across. If anybody has questions or thoughts on that, I would have a look at a keen interest in that. Now, Jim is saying with a very good point, and that is we could show how much money has been put in and taken out of the trading accounts, but then that sort of, which is a very good point, but then that clashes with the point that people want to be private and want to be showing how much live money is they're trading there. So the way we solve that, Jim, is we show the trader's value at risk in the Darwins. So you know how much money the guy's got at stake. So you can come here and you can see in the top right-hand side, you see that this reckless trader can lose more than $10,000 in a bad month, as you can see here. So the amount of money at stake that the guy's got, which is not affected by this depositing and withdrawing, is listed here. So we try and solve your concern, Jim, by looking at what the trader's got at risk rather than showing the deposits and withdrawals. And there's all sorts of reasons why some people don't want to show, for instance, to the taxman how much money is going in and out. So I respect their the claims for privacy because they ultimately pay the payroll of meanwhile 34 people at the company. Anyway, sorry for the detour. So that was the risk level. Then the other one is we're now getting into the point of psychological bias, and the fact is humans we all share very similar biases, and one of them is underestimating the likelihood of extreme events. So this is one of the books I'd recommend you guys read. You probably have read it, probably anyways. It's called The Black Swan by Nassim Nicholas Taleb, and it shows, as you see here, the impact of the highly improbable. Showing that in financial markets, what looks like very, very unlikely events tend to happen an awful lot more often than you'd expect. And so if you basically leverage yourself thinking that it's all going to be fine, it's mostly fine until one day it isn't, but then you've lost everything you had. So no good in having over leveraged yourself. That's one of the points. The other, and this is one book that I think I apply to anything in life by this point, it's called Thinking Fast and Slow by Daniel Kahneman, who is a Nobel Prize winning behavioral economist. And I can only recommend this book. You'll have a lot of insights from it. And one of them is understanding the concept of loss aversion. Loss aversion is a bias we've got that comes back from our reptilian brains that basically makes us loss averse. And translated to trading, this is what explains the adage of let your losers run and cut your winners. Essentially what happens when you're trading, and loss aversion is, by the way, something that is only triggered under stress. So if you're trading, if you're in a position with a leverage of 2-to-1, where you're feeling totally comfortable that you're down for the time being, but you'll make it back at some point, you behave in a completely different way than you would behave in the very same position if you were leveraged to a degree that made you nervous. Of course, the amount of leverage depends on your gut, so how used you are to leverage. But the fact is, there's a point where your loss aversion is triggered, and then you essentially poo in your pants, which is another way of saying you jumped your stop loss, you just don't shut it because you think it's all going to get better, but then eventually it doesn't. That's when it goes down. That's the loss aversion. And also when it goes up, what you do is, I'm making so much profit now, and if I will lose it all if I don't get out of this trade, so I better get out whilst I'm still winning. And if you do that and your loss aversion trigger is triggered, what you will be doing is engage in a systematically losing strategy, because you'll be much more likely to hang on to your losers than you will be to hang on to your winners. And over time, that just ends up in a loss. So a very bad way, or roundabout way of explaining what the guy does much better than me, but I highly recommend this book, not just for trading, but anything in life. So I think it's a good purchase. And I don't get any money, by the way, from recommending it. Last but not least, there's the big point in here that we haven't really touched upon, but is the very reason why Darwinex even exists. And that is as follows. And I'll show you some numbers to back this up in a second. Now, the guy that I think is the person who's done the best by investing people's money over time, at least in the last 50 years, would be Warren Buffett. And Warren Buffett, I don't even know how many billions the guy is worth by now. Luckily, he's promised to give it away, but which is beside the point. The point is that he grew from, say, 1 million to like zillions of billions. And the investment return compounded on average that he has delivered over the years is 20% per year. Basically, it shows you that all you need to do is keep delivering 20% consistently year in, year out. Now, there's a paradox that is what justifies Darwinex, and that is that if you trade your personal capital, as highlighted here by 5 peanuts, and you grow it by 20% per year, then all you're making for 2,000 plus hours of trading in front of a computer per year is 1 peanut, which is obviously not enough to pay your bills. Now, if you did just that, but instead of trading your own personal 5 peanuts, you were trading 10 million of investor capital, then the picture changes completely, even though you're not doing anything different other than growing money at 20% per year. And that is, you have your 10 million bucks, you grow them by 20% a year, you charge a 20% success fee, which gives you a 4% on 10 million, which equals 400K, which is a much more handsome way to get going, at least if you ask me. So And this is the point we're making right now. And the point is, retail traders are not doomed because they're subhuman, stupid people. They are doomed because regardless of what they do, they're never going to make a living from trading unless they start from a decent amount of capital. On the one end, we've seen what happens. So basically the choice is as follows. You start with 10K, you grow them by 20% a year, and you end with, say, well, nothing essentially, because you can't make a living on 2K per year. That's option A. Obviously, that doesn't really appeal because you can't make a living off that. So you fool yourself into option B, which is what we've seen. And that is, I basically leverage myself to the bones, hope that it goes well. And then at some point in the future, when I've built up my capital, I presumably will behave more rationally, so to say. And then I can focus on making my living from trading. Of course, as we've seen, pretty much everybody fails in that quest. So this comes back to the point of the failed business model. You're doomed one way or the other. You're doomed to eat peanuts in one case, or you're doomed to blow your peanuts in the other case. But either way, you're not making a living unless you get to manage investor capital. So what is the best way to get out of it? Well, I've taken here what I would consider an archetypical statement from the guys that have good sustained performance at DarwinX. This is one of the Darwin providers who chose to stay anonymous, but he agreed to sharing this point in his profile, and that is as follows. I'll just, you can read at your perusal, but the point here is we're talking about somebody who got into trading in 2007 with a pretty heavy background. So it shows somebody who really is committed to whatever he does. He came into trading because he wanted to do things by himself, not because he wanted to make money or anything else. He just, he really embraced the challenge for the pleasure of the challenge partially. And it took him 5 years to get to a point where he started being consistently profitable, which basically proves the point I was trying to make. It's not easy to get there, but if you persevere, you get to a point where you can make it. And once you got into that point, the choice of model is what really matters. Now, these curves are, I will probably do a very bad job of explaining today, so I'm just going to write here something you can Google, compound investor leverage, which is a term I made up to show up on Google searches, with a video, which is, I think, arguably the best I've done to date, that explains the differences between two business models. One business model is I trade my own capital. The other business model is I trade my own capital, but then I get investors to pay me 20%, which is the one we've built at DarwinX for. So what do we see here? Well, the numbers are here are done, and I can share a spreadsheet where it's all done in detail. But the game here is, okay, I start on year one with 3,000 euros of personal capital, and I grow capital at 20% per year in, year out. Obviously, over time people will have drawdowns and volatility, but that's beside the point for the exercise. So arguably, after I've got a track record of, say, 3 years where I've grown money at 20% per year, then I can convince a guy with $1 million to pay me a 20% success fee on whatever I make him, which is going to be 16.6%. No, actually 16%, because if I make 20% raw and he pays me 20% success fee, he keeps 16% of profits, I keep 4% of profits, which I then reinvest with my own personal capital, and this is how the green line grows. Right, so I'm making 20% per year. I get the success fee from investors, and I reinvest at 20% as my own money. And if I do that, after 13 years, I've built up my capital to 1.5 million. Now, I think that's highly unrealistic as we live in the age of Twitter and viral expansion and so on. And you can bet the guy who gave you 1 million when you were 3 years into your 20% success rate has some golf buddies that he brags about his investment with traders, and those golf buddies presumably like to invest with 20% profits. So those guys then tell other guys, and you have some virality going with your investors, which then makes you grow exponentially faster than you would, certainly by growing 20% a year, which is the peanut problem as you see here. So if I start with 3,000 euros, and I make 20% per year until year 13, I'm still making nothing. If I make 50% per year, which I think is totally borderline on excess risk already, even then, if I still made it, which I doubt anybody would achieve because Warren Buffett didn't make it, you would still be stuck with 500,000 euros by just trading your own capital. And all this to say that much sooner than you think. So basically, 3-4 years into the quest, you're much better off managing investor money than you are by growing your own monies. And this is the single reason. If there's one lesson that I can provide today, and I'll be happy to share the spreadsheet so you can play and reach your own conclusions, is as follows. If you only trade your own capital, you're doomed one way or the other. Retail traders go for option 2, which is to try and fail. At least they had a shot, because the option 1, which is to grow money at 20% per year and eat peanuts year after year, is even less appealing than giving it a shot and trying to win the lottery. So my final argument, I guess, would be to say retail traders are not stupid. They are actually optimizing according to their constraints. They are producing strategies that are no worse than those by institutional guys. But the fact is that playing a game which is impossible to win, and that is you can't win more than 20% per year, because the only guy who's done it in the world is Warren Buffett, and he hasn't grown it more than 20%. So look one way or the other. That's the key lesson. So in a nutshell, you'll need patience, no question about it. You'll need persistence, even more of it. Notice I haven't put the point of talent anywhere here, because I don't think that's what really counts. You need to come into this with realistic expectations. And certainly, and this is probably the most important insight, this is all about the road, not about the endpoint. Meaning, if you come into trading just to make the money, it's probably better you quit and go do something else, because there is research after research after research which proves that the people who end up being successful in life are the people who do the things they like because they like them, not because of the pay they bring. So yeah, that was, I guess, the message that I wanted to bring across. I mean, in my case, I certainly enjoy the ride, and it's always a pleasure to see the numbers growing of people who keep following the Darwinics movement. So all I can say at this point is thank you. Let you know that the YouTube channel keeps growing slow and steady, as our friend 50 likes to say. So if you want to subscribe to it and get the videos when they're done, just Google Darwinics YouTube and you can subscribe there and then. Then there's feedback. I can't mention how much we love feedback at DarwinX, so I just want to give you an insight into the inner workings of DarwinX, where what we've got is we use Slack, and Slack allows us to communicate within the team, but also any feedback that we get from guys like you, and some of this is in Spanish because we have Spanish users and so on, but there's also some stuff in English, as you'd guess. Everything is posted for all the 35 employees at DarwinX to see, and there's nothing that pleases us more than seeing people who care about the product, who criticize the very obvious gaps we still have, and who really help us get to a point where we can deliver service that's worth your time and your effort. So if you think there's any way we can help, our mission is to empower independent traders. So please don't hesitate to reach out. And last but not least, thank you so much for being here today. So let's go back to the questions, and feel free to write anything as I go. I'll try to process in the rank. So there's Paul, who said, I think it would be better to show traders risk as a percentage rather than dollar amount. Well, actually, we have not chosen to do one or the other. You've got the value at risk, which is the trader's percentage risk. So that covers the percentage bit. And then we also show the absolute amount, which is what I've shown. So different people prefer different ones, and that's why we show both. Then there's a point by Vlad saying that we should get the extra insurance on deposit, so those guys won't have any excuse anymore to deposit only 5K. I'd like to think that way, but Vlad, the fact is the deposits are guaranteed for 50K, and people are still doing it for 10. So I'm not sure that's what's the constraint. I think more likely, I mean, if you go to my FX book, and this is amazing, the rotation and the churn in brokers is almost as high as the churn in traders. So, I mean, I totally respect that people still consider us an upstart company. So we've been around since 2012, but I think confidence is something you have to earn gradually. So we'll just have to be here, return everybody's monies, and treat them well, and eventually, I hope that we will gain their trust. Vlad is making a very good point, and that is that most strategies cannot handle more than a couple of million of investor capital, and that certainly is one case. So over time, that's another topic that gets heated discussions, and that is the Darwinian winners very often are guys who trade non-scalable strategies. And those strategies will never scale beyond a couple of million of capital. And that may very well be true. But on the other hand, I would say if I was an investor and I was given the choice between making 50% of my billion by allocating 1 million each to 1,000 strategies that win 50%, or I had to give my money to 1 billion strategy that makes 20%, then I would not think about it twice. I would go for the small non-scalable strategies for two reasons. One is because they yield more profits. And two, and more importantly, it's because at some point people are going to find them out, and it's only if they're very small that the big guys will not pick up on them. So I think I agree that individual strategies are not scalable in capital individually, but they certainly are scalable in numbers. And from an investor standpoint, I do not think that a non-scalable strategy is inherently less worth than a more scalable one. Obviously, from the standpoint of the trader, if you're looking at just optimizing for strategies that make 1 million per in capital, you probably would need to think of building 5 or 6 strategies so that you can build the business model. And Vlad, yeah, so there's the point of the viral growth basically when you're growing money 20% per year, you don't need to worry about anything else because the investors will just come knocking at your door, no problem. So Victor is mentioning a point about the correlation of strategies. I totally agree. The correlation of strategies is very important. That's what we actually computed. So you can come here, you come to the Darwin and go to the correlation tab, and you can see rank in descending order. The strategy is more correlated to those, and certainly there are a whole bunch of EAs that are essentially identical. So you'd better check on that before investing on two identical twins and not diversifying really. There's a point by somebody mentioning that the market was changing in the third week of April. I really don't know what that is. Then there's somebody who has learned a lesson here the hard way. Don't worry. I mean, I think everybody has learned. The only way to learn lessons is the hard way. So don't put yourself down for that. Vlad, as usual, is disagreeing with some stuff, and I love you, Vlad. It's always great to have people who represent the other side of topics. Happy to take it off in more webinars. Jim is saying that if I am saying that a lot of potentially good traders are falling due to their own lack of capital, and my point is absolutely. I think the single reason that explains failure for most retail traders is not down to retail traders, other than the fact that they don't have the money to begin with. And that's the vision behind DarwinX is just that. Like, time will tell if I'm right or not, but that's absolutely what I believe, yes. So Dave is asking that my link was sent by a friend, therefore I don't know what DarwinX does. Well, you can go to darwinx.com, and we have finally managed to put together a homepage which more or less halfway explains what we do. So I think just go there, and I think it's explained there. So, well, I think I've run through the list of questions. It's been a great pleasure to be with you guys today. As I said, the webinar is recorded, so you will receive a copy of the YouTube link in case there's anything that you want to look over again. And again, if there's any suggestions on other webinar topics that you'd like to hear about, this is it's always a pleasure. And I have to say I thoroughly enjoyed this. Is probably one of my favorite points of the week. So I look forward to excuses to doing even more webinars. Okay, well, looks as though everybody is ready for the weekend, so as it should be. For my part, I'll be going to celebrate my 40th with some buddies, just friends without wives. I certainly encourage you guys to do something similar whenever you can. It's healthy, and I wish you all the best. Thank you so much, and best wishes. Take care, guys. Bye bye. Bye bye.